So, last time we were able to solve, at least I was able to solve assignment 2, value and probability of default. So I was able to define what is happening under inflation and then how free cash flow of the original company and my flying dustbin rocket will perform. And then we can see not much happened with the weighted average cost of capital, because in this assignment I should optimize the weighted average cost of capital way more than what we can see here, because it was mostly untouched. We can see that, okay, salvage value increased because of the higher pile of cash what I was able to generate at the end of the last year. So discounted cash flows were also happy because of high profitability, and that's why the value of the company became higher. And also with the also no score, last week we were able to prove that also probability of default dropped from this nearly 80-90% to 20 something. So at the end of the day, we can see that the company is robust, just we know that we need funding desperately. Or at least my company or my setup scenario requires this desperately, because I'm barely profitable, so practically this is zero that I can earn in the first year, while we have high expenditures in the first 2 years already. And this is a huge danger for the company. So today we should solve this problem, that how can we get funding for our company. So in assignment 3, long-term asset and liability management, we have to determine that what kind of sources do we want to use, and in this case I will start just to overwrite everything here. So okay, we don't care about inflation anymore, not about free cash flow, not about capital structure. Capital structure will be updated anyway. What we keep here is the value, and yeah, obviously conclusion. Sooner or later we will need that one. So, introduction. I will zoom in because I think now it's visible for you. So obviously the company needs a financial buffer or a runway. So usually people are using the term of financial runway to survive the first 2 years until our cash flows are stabilized. We could say that, yeah, we will be already happy after 1 year, but if anything goes wrong, then we will be absolutely unhappy. So it's much better if we are saying that, okay, let's cover everything related to cost of sold goods, so all the manufacturing expenditures and wages. Because if we are happily exploding the rockets, which can happen, then we would run still a high risk. So originally I was just talking about 300 million euros, but if we are adding these numbers together, we can see it's way more. So to cover the first 2 years expenditures, namely cost of sold goods and wages, in my case this is quite simple because I can write here I didn't define anything more. Okay, so the financial runway what I need to collect already in the first year, let's give a friendly pink color for that one, and then we can see that let's add this one, and we should cover also wages because people prefer if they are paid. So €893 million. €893 million. Therefore, we have to collect. Let's make simple. So we need to collect €9 million. So after this point, yeah, from investors. Our options are equity, private equity, equity financing by issuing shares, new shares, at the original share value, because right now we are selling the shares in the original company, so not with the business plan. So in this case, it's not original share value, original corporate value. Then maybe let's use more refined structure. So private equity financing. Okay, the other is more simple. So bond issuance, 5-year maturity. Bond issuance. Maturity. And the last one, I don't care about loans. I will delete it because bonds are covering everything what we need. So the last one is financial lease. Sum of our assets and leasing them back. So practically it's a lease back contract. Just so we have to see and we have to assess how these things are affecting the value of the company. So how they are contributing to shareholders' value, and also how they are affecting probability of default. So no share value. Yeah. So simple it is. Then let's go through all the different options, and after that we will see. So funding with new shares. Okay, and this is when the dilution can be started. So in the case of the original setup, so with the which is the same for everybody. So this is Ariane 6, no recovery and utterly useless. So if we are checking, and we know the distress, so it is in distress. And also we can see the valuation. So the first problem is that if we have to issue shares, this is what people can see. So if you are asking someone to determine the value of the company, they will have some kind of a value for the company around this level. So now we can see that, okay, value of the equity in million euros. Right now we have 1 million of these shares. So if we are starting to increase share numbers, the problem is that the individual share value will drop eventually. So in this case, the question is that not PowerPoint, sorry, Paint. So let's use advanced graphical representation for this problem. So if I have to determine that, okay, this is the number of shares. Oh, okay. So there is the number of shares. We have to add the number of new shares. And the problem will be that this will be still equal to the value of all the equity. So practically they will start to drop. So as a result, we have to identify that how much money can we earn by selling additional shares for the clients, and especially when we know that we have to collect at least 900 million euros, which will be a lot of dilution. So yeah. So in this case, if I'm just saying, it's already there. Good. So if I start to increase the VC share here, so 10%, it's enough. Okay, and also we have to calculate that this multiplied by this one, multiplied by this one. So how much money can we collect? And also we have to divide it by 1 million because we are talking about millions. So if you are just selling 10% of the shares to venture capital, it's not enough because we collected a small set of money. Close enough, 15%. 17? No, it's too much. 60. Oh, it's also too much. Then 4, 3. Yes, this is perfect. So we have to sell 15.3% of the company to a venture capital firm, and it means that we have to sell also 153,000 shares. So to collect required which gives three. It is good because if we are assuming that we are a venture capital investor in this company, then now we have a strategic influence because we are above 10%, so it's okay. Yeah. So we should stop here because this is the original setup, and now we should start to say that okay, I will create different subversions. So I will just save a copy that name is sample, this is equity. Financing only. So we know that we need this financial runway. So now we can see that, okay, I will increase the cash reserves. I will just keep it here. Okay. And I will increase the cash reserves by 900 million. Because now the money is in the company, but also in case of valuation, oh, sorry, still we are at the balance sheet. So I have to increase also the common equity by additional 9 million. And during for all the years. And we can see that, okay, I have to increase also the number of shares. It was backwards. I cannot do that anymore. So plus. So obviously for you this will be a bit different if you need different amount of money. But the same is that in the original setup you are defining that how much money you have to collect, and after that it will be visible. Okay, so the VC share is still 15.3%. So it should be remaining, obviously, because we are selling the shares. And after that we can see that, yeah, so if the share price will increase because we are successful in the implementation of this strategy, then obviously we can earn a lot of money by doing something. But also we have to check that, okay, shareholders' equity is still 100%, so we did not touch anything there. So it doesn't have much influence on the capital structure of the company because it was already funded through equity and now is still funded through equity. So nothing is changing here at the level of VACC. only now that we have a lot of money. And that's why we can be also really happy, because at least financial revenues, originally it was set to 0, but due to the financial runway, okay, I will delete this and I will just add 9 million, because in this case we can say that instead of this stupid number we are linking it here, and also I'm adding it here as well. In this case it can help you to calibrate all this stuff. Yep, okay, content is the same, just now it's more elegant. And also, since we have the financial runway and we are not just keeping it as cash, come on, we are not stupid, so we have to invest this one, so it will generate some interests, which is good because it not just provides us safety against unwanted risks, but also now profitability has been increasing already. Only because we realize a lot of revenues on interests. Yeah. Okay, do we have to do anything more? So obviously it has an impact, that's why on the EBIT, this will have an impact on the floating capital. Yes, on the floating capital definitely, because floating capital is related to the cash reserves. So this has been increased drastically. And also the distress levels will be or should be decreasing, because the original setup was had lower cash reserves. So from 0 we went up nearly to 1 billion. So yeah. So in this case, this will not affect much the weighted average cost of capital, as the company was mainly funded from equity already. But lowers the probability of default and increases our financial revenues. So now we can just fit in the Ozono ratio, and also in terms of valuation, yeah, this is the value of the company, so we can add it here. So that was the simplest part, because we just have to increase share numbers and then deduct that how much money can be put together. Okay, drastic increase. Yeah. Okay, next thing. This will be less easy. So bond issuance. Still we need the 9 million euros, but it will be variable interest bond. Oh, which one do you want? Variable interest bond or fixed? Hands up if fixed. Fixed interest rate, variable interest rate?
One issue.
Yes.
Long term.
Yes.
Fixed.
Fixed. Okay. Cool. So Because if we are checking the data, then in case of markets, fixed income, and then bonds, not credit, I think. Yeah, the credit, corporate bonds. In the past it was just under the bonds menu, but they needed to put it behind different levels. So right now we can see that in case of or for European companies, also several years ago we were able to see everything at country level, but this year they moved everything under the umbrella of EU or US and so on, which is sad. So we can see that what is the actual yield for corporate bonds at different ratings, and what was our rating besides terrible? Yeah, we mentioned that, okay, it's double B. Okay, let's be double B. So we can see that if we would like to get funding for 5 years, we can issue bonds at 4.1% of interest rate. So today, double B rated bond, corporate bond can be issued with a... So this is the same for everybody, for you, for me. 4.1% interest rate in the Eurozone, which is nice. Obviously this can change. How much, you can ask, and I did not want it to download the huge database again and again, so I already downloaded the data yesterday, and already you can find it on your CoSpace, and also if I can find it on... Yeah, wrong class. Risk management. Yeah, so... Yeah, Eurobonds. This is... We already see it on CoSpace, just for myself. So there is a standalone Excel sheet where you can see how different ratings in Germany and in France were changing, and also corporate bonds with triple B rating, so we need double B, whatever. So from 2015 until 2025, so from the last 10 years, this is what we have. Sometimes, okay, inflation can be peaking here, so this is sad. So for this time period, when the inflation spike happened, investors were funding corporate bonds at negative interest rates, so practically they did not have any real revenue. But otherwise, we can say that even after the increase in the interest rates, this is really cheap. So getting funding at 4%, come on, guys. So if we are just checking that, okay, yeah, this is triple B for Euro for 5 years. This is what we need. So if I'm just fitting diagram with all this box diagram. Then we can see that our funding can be mostly between 0.5% and also 3.2%. And on average, it can be around 1.03%. So this is dirt cheap. So yeah, we can say that, okay, we can get funding at this cost. But in this case, we would stuck somewhere here at this level. So even at historically high levels, but common is still 4.4%. So as a company. Okay, so before we are moving on, we have several things to consider. First, I have to download the double B because that one is quite useless. Yeah, because there is at least 1% difference between the two ratings, so sad moments. At least I can be fast because I have the RIC codes. So opening my apps, then and also if I'm moving this one here to enjoy the beauty, now we can see that, okay, it can fluctuate way more, but still we are at peak, nearly peak price. No? Yes. So it's already here, but I will update it and now it will be even here. Yeah, it was saved now. Double B. Yeah. So we can see that worst case scenario can be that we can get the funding at 7%. Best case scenario, we can get the funding at 1.4%. So this would be the case if we would use variable interest. But since you were wise and suggesting that we need fixed interest, then we can also easily model what will happen with us. So we would like to issue a fixed interest corporate bonds to collect the 900 million. The bond will be not amortizing, so we will just repay everything once expires. So this is the simplest way. Yeah. Okay, what is the price? In this case, we can say, should I do it here? This is bond related, so why not? Just after that, nobody will find this, so no. So that was the original case study, we don't need this. That was the already modified, don't need this either. So let's create a new save file. Don't you say I didn't make save file for it. Okay, so I have to download the untouched. Please don't open, you just have to download and not to do anything. Okay, there was some there, whatever. And now I can create the second alternate, which will be bond. This name is bond, fixed bond, and then we can just create. Okay, at the end of the day we have to create something like this, but right now this is empty. So bond value, because always the question is that how much money can we earn by issuing this bond. So it's not just that, okay, I'm issuing something and then it will be collected, so we have to do proper bond valuation. So first thing is year. First year, second year, fourth year, and so on. And we need only one digit for that. Then we have to have the interest rate. And this is, we were deciding that this will be our fixed interest rate, so you have to change to decimal commas, and this is percentage. So all these time periods, we will have this. And also we have to decide that, okay, the capital of the bond should be, but at the end of the day we have to recalibrate this because we have to collect 9 million, and obviously if the price will be under 9 million, then we have to increase the capital, repaid capital, sorry. So to be precise, this is the notional value. Which have to be repaid at the end. So now we can see also cash flows. So payments. And we can see that, okay, this, so our debt multiplied by the interest for the, and also it's nice if we are using dollar marks. In this case it's not messed up, and then we have to also add back to the capital because we have to repay the capital. Then next thing, we have payments, but also we have to have the discounted value. So in this case we have to define a discount rate. In this case, the question can be that what is the discount rate here? Usually people are saying that, okay, let's use government bond yield curve data. So what is the actual funding for government? Because we don't have better indicator. So if you're already in the database, then let's go back. And let's check that, okay, markets, fixed income. Let's see French government bonds as the risk-free rate. And instead of world, land France. France, yes. And then it's 2.742. We can say that, okay, I'm using the same maturity, so it's, at least we don't have term issues, and after that we just have to use the usual present value calculation. So this equal, it was a cash flow, then we have to divide it by 1 plus the discount rate. The discount rate is fixed. Divide, on the power of the year. And then big Tom, yes. Then these are the discounted values of the different payments, and then we just have to sum them up. This plus this plus this plus this plus this. And then this is this is the price where we can sell this government bond, this corporate bond. So we can say that this business can be absolutely lucrative for us because we can collect more. We don't want to collect more, so I should just start manually adjusting this. Nearly. No, it's a bit low. Yes, well, close enough. So we can see that we can collect. So putting it here and then uniting this cell. So we can collect 900 million euros at the point of issuance, but when it expires, it will be just this amount of money. So good enough, because we are selling it at a huge discount here. So this is completely the risk premium. Okay, so now we just have to write it in. So the bond is not amortizing, the bonds are prepaid at the end. And under these conditions, the price of the bond will be now but our debt, so the notional value will be increasing only by so we can save some money. Which is cool. I like saving money, so now we just have to modify everything. So in the case of profit and loss statement, we can see that, okay, our cash reserve, so again, financial runway, we have to define it here. Round way. And that was Bing. Yep. But also, I'll be writing it here that we have this new corporate bond. Just to highlight that we did something like this. And in this case, the debt is only this number. So, our cash reserve will increase happily with this additional funds where we sold the bond, but our debt will only increase with a smaller number because of the magic of bond pricing. Yeah, and let's see how the situation has been changing. Not good, but not terrible. So paid interest, sorry, financial revenue, still we have to increase this one. Because it was set to 0 and now it will be not so terrible. So we can invest the savings at this rate. Now it's positive, yeah, we are saved. Because our paid interests are at this level, but we have to correct this value coming from interest on debt. Or debt is not this one. So we have to make this work. And we know how to do that because we just have to change interest rates. No. So based on your colleague's suggestion, now we have this interest rate. Still profitable. Yes. And then more and more profitable, but still we can survive the first year with such capital buffers. And okay, as you can see it here, there was a slight increase in BB funding costs. So that was a year ago, and now we can see that it increased drastically. Okay, let's check that cash reserves are adapting, also debt has been adapting. Then let's check valuation. Obviously floating capital should increase because of the higher cash reserves, but what will change also the weighted average cost of capital, because now we should see here different numbers. Is this much different? I deleted, so it's not much. That was the Ozolo. Let's see that. Oh, I don't want to edit anything here. So it was under 3%, now it's at 3%. So it was not that efficient in terms of capital cost because I was able to increase the capital cost by introducing the debt. Yeah, because if you are seeing, or if you are checking that the required or the rate of return from equity is lower than the debt. So logically, we could say that it's not reasonable to increase debt in, or so not to increase liabilities, it's easier to increase equity if we can find someone who would like to invest into our company. But anyway, no, you are saying that no. Okay. But maybe I have already... Oh, I have the original DCC. So VACC. So which one is... This is... So as a result, so the weighted average cost of capital increased a bit due to the different capital structure, due to the more diverse capital structure, more diversified. Yep, 8 jumped. But it's not a significant jump. So if we are saying that, okay, let's not use the minimum of 2, but the minimum of 0, then we can say that, yeah, it increased, but who cares? Let's see the impact on value, because this is what can be relevant for us. And also the distress. Yikes. Maybe we are not supposed to do that, ladies and gentlemen, because we can see that yes, we were able to decrease the probability of default, just it's still high. Okay, the compound rate value increased, but the depth is so huge that not so delicious. So practically we are not compensated in terms of not in value and not in probability of default. Meanwhile, neither the corporate value nor the probability of default did not compensate the higher depth levels. So please don't do this. This is the conclusion here. You can ask the question that, okay, but what happens if we are using floating rate? The problem is that under floating rate, it's way harder to model the pricing, because here we at least had the same interest rate. So if we don't have the same interest rate, then we have to add the yield curve data. And this can be even more serious. But we can check, so I'm not just talk about it, but okay, so this is the fixed interest rate, and this is just the floating. So, what can we do here? The easiest way is when we are going back to, I can't see anything from the sun. It's so nice that we have sunshine, just it's always, doesn't matter where I'm located within the building, but it's always shining on my laptop screen and I can't see a thing. Fixed income, bonds, credit, then corporate bonds, then EU, and now we have the beautiful shiny yields. So now we can see that the first year we can get the funding. At least right now we can build up the funding model under these circumstances. Now we don't have fourth year, so Unfortunately, in this case, we have to do linear interpolation, so that's divided by that one and divided by 2. So we can see that obviously the price at issuance will drop, so we have to increase the debt more. I mean by a lot of more. No, not that much more. 75, yeah. So it's also not lucrative to do that, because our debt levels will increase. Why? Okay, average interest rate. What is this? Okay, the capital cost will drop a bit with higher debt, so maybe it can be useful, but 3.5, is it better? So you see 3.5, why we can get equity funding for 2.7 something. So no, we should, in this case, we should skip this idea. Even if we are saying that, oh, it's 4% is nothing, or 5.2, 3.5% is also. Yeah, because here we can see all the big private equity investments. So when I mentioned that, oh, we need 9 million euros, you can see that just in 2022 they were able to collect or raise 1.7 billion US dollars only from one VC capital investor. So we are just talking about beans. And it's quite interesting how they were able to scale up this investment. So after 2008, when they got the NASA contract, they had just this 20 to 30 to 50 millions. And once they started to fly, then we can see that in 2015 they got already 1 billion as an investor or from an investor. And after that, some millions of US dollars dropped in again as from private investors. And then there is this other 1.9 billion. Then again, some 100 millions were arriving. And after 2022, we can see that they closed down. Or at least we cannot see, but mostly they were closed down. So they are trying to use only equity for funding, but if we are checking, financial summary, I know that somewhere I was able to find their loans. They had one variable interest loan. Just since it's a private company, then no. Then let's see debt and credit. It's so strange for me that in case of Hungary, financial annual reports, they are in public database. So you can download any company which is providing, and it's mandatory for them to file their annual reports. So they cannot choose. And after that, at the same year, once it's submitted, then you can see it in online public databases. And in the wonderful USA, you don't have anything. Okay, maybe this one. No. Okay, they removed it. In the past, they had only one variable interest loan with 4.25% above the market benchmark. So that was all what was visible. So let's not care about this anymore. So we were able to see that what happens with bond funding. Maybe in your case it can be completely different if you need lower amount of money, but in my case I can say it's disaster, but based on the probability of default and how high it is a disaster. So nope. Then still I have financial lease to check. And in this case, okay, so we have the financial runway. And do we have enough assets? So we have. The problem is that even if we are selling all of our properties and leasing it back, this is absolutely not enough. Especially that it's depreciating. So for me, this is not an option. What I can do is only that I can combine financial lease with some kind of a bank loan, which is meh, but okay. So it's within the game, so I have to stay within the game's rules. So financial lease. Maybe I can sell for all the properties for this amount of money and then recover from it later on. But I need a bank loan also. For your strategies, I think it will be no problem, but for mine, I need way too much money to survive. So, yeah, high maintenance company. And so now we just have to price in the lease at first. So in the case of financial lease pricing, we know the equation, just for refreshing from yesterday. There you are. So this is the equation what we have to use. So we have to define asset price. We have to define the residual value. Okay, let's write it here. Of the asset. But we are saying that, okay, it's %. Asset value is the same what we decided here. So there you are. Luckily, the balance sheet will not change because still we have the property in our as our assets, is depreciating and so on. Just, yeah. In theory, we could go for this number as well, but okay, let's be conservative. So even at this level, we should show some respect for the market players. And okay, after that, we just have to define the interest rates. So R0, R for the lease company. And also, we need, we know only R3. That's all what we have for as an idea, but in this case we need the default rate and we need the time to default. And you can remember that yesterday we were analyzing this on your corporate default and something study. And then instead of scrolling like yesterday, now we can just go to the preferred table. Oh, but it remembers where was I last time. So, good. Average time to default 3.9. This is in years. And maybe I will just copy here the original or the source of the data set. And the other was corporate default rates by industry. That was the other. Obviously, this is the same thing for you as well. And we are going for the highest number as possible because we would like to have a conservative estimation. And then, and also, since we are using the source from here, thank you guys. I don't know who you are, but you are saving the day. And then we just have to do the division, default rate by this one. It's already in years, so we don't have to care about the months, but we have to do the multiplication by 2 to meet Basel standards, and this is already a percentage. So yeah. Okay, then funding cost for the leasing company. Leasing companies are banks, so now we just have to find a bank. MRCA. LTA. Is this the... No, this is a different company. Okay, so they are in everything, so it's not good to use them. Then we just have to go for some bank. The credit is big enough, so if we can see that how their debt is funded, this can be completely enough for us. Okay. So for 10 years, they can get a funding at 3 point something percent. So let's pick up this one because but we need funding only for 5 years. Okay, so let's make things comparable. We can say that 0 rate or yield. Let's use 0 rate because this is a more defined version. So now from all of this, we can get the interest rate for the leasing company. And also, still, we should not forget that there was one more. Where are you? There was the commission. Yeah. Come on, guys, they have to live from something, so we cannot say that just they have to do it for profit. Two. 1%, 2% margin. Well, let's give 2% margin, and after that we start to play with that later. Fine tune it. So interest rate is quite high. We are too expensive. And then we can just start to play up, to build up this asset price. So base fee annual will be bracket starts asset price multiplied by 1 minus the residual value multiplied by 0.9 because of US GAAP divided by divided by 1 minus bracket opens 1 plus R bracket closes on the power of 5 minus 5. This is an annuity, so and divided by R. So this is the money what we have to pay from year to year to maintain this lease contract. Is this expensive? Yes. Is this more expensive than anything? Definitely. And also we have the bank loan. So not just this thing, but also we have to define the bank loan. So originally I was following SpaceX, so you can see that interbank lending rate plus 4.25% because SpaceX had these conditions. Now they don't have this, but we can see that interbank lending rate because they were using LIBOR plus something. So let's go back to the data set and markets, in this case money markets, because this is short term. Then yep, euro is the first one, and then we have to go for the 1 year. Yeah, 1.95%. Okay, this will be cheap, I can see it. 2 point. What have I done? Okay, it's 2.01. Then 2.34. then 2.46, and 2.6. So we can see that since a year, at least short-term funding for banks has been decreasing a bit, and 0.7. But still, for us as a company, this bank loan, variable interest rate bank loan, is still a lot of, it's quite expensive. So if you are saying that, okay, paid interest, paid financial lease, it's already prepared for that one. So okay, we can say that equal this, which is a lot. And also, at the end of the day, we have to buy this thing back. Plus. But we also did not care about the bond expiry. So, okay, let's not change this. And also paid interest. Now its interest on debt is this one. And then we have to say that now we have the bank loan, so this plus this. Much better. So instead of borderline profit, now I'm in huge losses in the first year, so only from that. Much better. I'm so happy for that, because in the past when I was teaching this and we had 0 interest rates or 1% interest rate, it was always negligible to say that, oh, we don't care about the capital structure of the company. Now we care. Especially if we can see what is happening with the European companies or with some of them. So let's check. Are we in distress? Oh, absolutely not. So this decreases. Not so bad as it was before, just still terrible. Is this good? Oh, yes. No, I did not increase the financial, sorry, okay, assets are increased, still in losses, but at least we have, yeah, financial revenues must be compensated. Okay, that's a mistake. Still in losses, just, okay, now it's less terrible. We have, okay, time is up. So this is where we stop for today, and then next week we will be finishing this long-term funding topic. And at the end of the day, we have really disappointing news, because we don't care about funding with equity at all, because other alternatives from the bond markets, they are terrible. Okay.